welcome back to Michelle's Money Mind. So I have one question for you today. How would you react if the market crashes? So the market's crashing, your portfolio dropped 15 to 20% in maybe a week. Recession fears are everywhere. What do you do? So I'm going to give you 4 options. So A, stick to your plan. B, worry and consider making big changes. C, ignore it and hope for the best. D, feel a rush and want to act fast. Be honest, which one would you answer? Drop your answer in the comments below right now. I'd love to hear from you. We'll break each one down and talk about what it means to your investing mindset. This isn't just a fun quiz. How you react in a downturn says more about your success as an investor than almost anything else. The market just doesn't test your portfolio, it tests your psychology. So let's break this down. Which response is best? What are the risks of each one? And how can you prepare now so you're not panicking later? Let's face it, this year it's been a little bit up and down in the market, especially with tariffs and everything. Not that I'm going to get into any political stuff here because I don't want my channel to be political, but let's go through each one. If you picked A, I stick to my plan and I won't change. This is what we call a disciplined investor. You've got a long-term strategy, likely diversified across all assets. You understand market cycles and you trust the process. History supports this mindset. If you had stayed invested during 2008 crash and during the COVID drop, you'd essentially have more money now, and then some. It's not easy, but it does work. This is where most professionals and investors aim to be. If you answered B, I worry and consider making big changes, that is pretty common. We've got an emotional reactor. This response is very common and very human. You fear what you want to control, and that often means selling at the wrong time or chasing safe assets too late. So the average investor underperforms market due to emotional decisions. So if this is you, don't feel bad, but know that panic-driven change usually hurts in the long run. If you pick C, I ignore it and I hope for the best, this is an avoider. You see your portfolio dropping and your instinct is, I just won't look. This mindset can delay smart rebalancing, tax loss harvesting, or even shifting strategies if your goals change. Ignoring it is different than being strategic. That's what I'm saying, so know the difference. If you answered D, I feel a rush and want to act quickly. Here's the market junkie. You might see opportunity or just get caught up in the adrenaline. Fast action can lead to buying the dip if you're prepared, but it can also lead to crashing headlines or YOLO trades. Big risks, big emotions, and big consequences. So what does your answer say about you? So if you picked A, you're likely to succeed in the long term. And if you pick B, you may need a written plan or financial advisor to stay on course. And if you pick C, you might benefit from setting reminders and checking on your plan quarterly. And if you pick D, you could turn your energy into an opportunity if you stay disciplined. The key isn't about being perfect, it's about being self-aware. Know your tendency now before you panic later. Here's what you need to do. Have a written plan, asset allocation, and rebalancing rules. Automate your investments in order to remove emotion. Like run simulations and ask, what if the market drops 30%? Would I be okay? Would you? Only you know that. I know that I would freak out a little bit. I'm not as risky as I used to be. I used to be way more risky when I was younger, and now I'm like, heck no, I think the market's too high, and I feel like it's going to drop soon, so I'm like not as risky as I was, which maybe is crazy, but like I know myself and I know how I feel about the economy as a whole at the moment, and I just feel like it's a little bit priced in too high, all the market, but maybe it isn't. I am, obviously if we just keep investing, then eventually 30 years from now it'll be worth more, but 30 years from now is kind of a long time, and I don't know. Anyway, so run simulations, ask, what if the market drops 30%? Would you be okay? And talk to someone like a financial coach or an advisor that can keep you totally grounded. Long-term wealth isn't built on the bull market. market, it's predicted in the bear ones. Remember that. Let's be real, market crashes will happen, and how you respond is everything. Drop your answer below, A, B, C or D. I'm really curious as what you answered it. And if this video helped you in some way, please consider subscribing. I would love to hear from you. Thanks for watching. Stay calm and stay smart and stick to your plan.